Most people form a limited liability company for protection and structure, but no one talks about the money side. If you don't set up the financial foundation correctly, your LLC may struggle with cash flow, taxes, and even legal risks. In this video, we are sharing 5 steps on how to build a financial foundation for your LLC. Step number 1, separate money and identity. The first step in building a financial foundation for your LLC is separating your personal and business identity. An LLC gives you limited liability protection, but you can lose that protection if you mix personal and business finances. So what does separation look like in real life? You open a dedicated business checking account and business savings account under your LLC name. You get an EIN from the IRS instead of using your social security number. You run all business income and expenses through the business account, and you pay yourself properly instead of swiping your business card for personal items. This separation makes bookkeeping easier, helps you claim legitimate deductions, and reduces headaches during tax season. Many banks offer special business accounts for LLC that include debit cards, credit cards, and online payment tools. If your LLC has multiple members, this separation becomes even more important for clear distributions and tax reporting. The goal is simple. Every dollar that goes in or out of the business should be traceable. When your money is clean and separated, lenders take you seriously, accountants charge you less, and you protect your liability shield with less risk of legal issues. Step number 2, set up your payment structure and taxes. Once your LLC has its own bank accounts, you need a clean payment and tax structure. LLC have different tax options, so you must understand how money flows. A single-member LLC is treated as a disregarded entity for tax purposes, meaning profits pass through to your personal return. Multi-member LLC are treated as partnerships by default and must file a partnership return. You can also choose S-corporation treatment later if it benefits you, but that requires taking a reasonable salary and running payroll. For payments, never pay business bills from your personal account. For your personal income, pay yourself using member draws or structured salary depending on your tax setup. Track all income sources such as product sales, service fees, online payments, and recurring invoices. For taxes, remember that LLC owners are responsible for estimated quarterly taxes because no one is withholding for you. Put aside money for federal income tax, state income tax, and self-employment tax if applicable. If you operate in multiple states, research state-level business taxes because rules vary. A clean payment structure ensures you never mix money, and a clean tax structure keeps you out of trouble with the IRS. Step number 3, budgeting, cash flow, and reserves. Most LLC do not fail because of bad ideas. They fail because of bad money control. A financial foundation means having a monthly budget, tracking cash flow, and building reserves. Start by estimating your fixed monthly costs such as software, rent, website hosting, insurance, and utilities. Then list variable expenses like advertising, contractors, inventory, and packaging. Create a simple budget that compares expected revenue to expected expenses so you know how much runway you have. Cash flow tracking is even more important because revenue timing matters. If customers pay late or platforms hold payouts for days, your LLC could run short on operating cash even when sales are strong. To prevent that, review cash coming in weekly and cash going out weekly. Use tools like QuickBooks, Wave, or even a spreadsheet in the beginning. The final step is building reserves. A basic rule is to save 2 to 3 months of operating expenses in a business savings account. This emergency fund protects you from surprises like delayed payments, repairs, or slow seasons. When you have reserves, you do not panic during short-term dips, and you can make smarter long-term decisions. Step number 4, financial tools, systems, and documentation. A solid LLC foundation includes accurate financial tools and consistent documentation. Start with bookkeeping. You can do it yourself with software or hire a bookkeeper as you grow. Bookkeeping tracks every transaction, so you always know profit, loss, and taxes owed. Next comes accounting, which deals with financial reports and strategy. Even if your LLC is small, having at least quarterly accounting reviews can prevent costly mistakes. Organize your documentation, including invoices, receipts, payroll records, contracts, and tax forms. The IRS accepts digital records, so you can scan and store documents in cloud folders. For payments, consider using platforms like Stripe, PayPal, Square, or ACH invoicing. For payroll, if you elect S Corporation treatment, use payroll software so taxes are withheld automatically. Also consider business credit cards to build credit and separate expenses. As your LLC grows, lenders and investors will ask for financial statements like income statements, balance sheets, and cash flow statements. If your foundation is strong, you can generate these reports instantly instead of scrambling. Documentation is proof of your financial maturity, and it makes taxes, audits, and financing much smoother. Step number 5, compliance, insurance, and long-term planning. The final step in building a financial foundation for your LLC is handling compliance, insurance, and future planning. Compliance means meeting state requirements such as annual reports, state fees, registered agent updates, and business licenses. Missing these can cause penalties or administrative dissolution of your LLC. Insurance is equally important. General liability insurance protects you from accidents or property claims. Professional liability insurance covers mistakes in professional services. Cyber insurance is useful if you store customer data. If you have employees, you may need workers' compensation depending on your state. These policies create a financial safety net, so one mistake does not wipe out your business. For long-term planning, set financial goals for revenue, profit margins, and reinvestment. Decide how much money stays in the business, how much you draw personally, and how much goes into future investments. As the LLC scales, consider retirement options like simplified employee pension, individual retirement account, or solo 401k for tax advantages. Proper planning builds wealth instead of just cash flow. In simple words, compliance keeps you legal, insurance keeps you safe, and planning keeps you growing. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.